Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn the IND AS 16, which is your property, plant and equipment. In this video, we'll particularly cover all the concepts which are there related to PPE, and there'll be one separate video in which we'll discuss the sums which are more complex and exam worthy. And specifically before we start, as you can see on the screen, the mind map is what I'm going to use to cover the entire standard, and all the concepts have been covered in this. So in case if you would want to refer to this, I'll make sure to link this in the description box below, or if there is no link of it, then you can head on to my Telegram channel. The link of the same is provided in the description box, and there I might have posted this. Yes, so now without any further ado, let's begin with the video. So starting with the standard IND AS 16. So what does IND AS 16 talk about? Like the name suggests, it talks about your property, your plant and your equipment. So what are the items that would get included in this PPE definition? Okay, that's what we are going to understand here. So there are a lot of assets that you come across, but when these assets fulfills the three conditions which are written here, that is when your it fulfills your condition and it can be called a PP. So now what are these three conditions is what we are going to see, which any asset has to fulfill so that it can be classified as a PP. Okay, so the first condition is tangible. That means it should be seen and touched. Okay, you should be able to see it and touch it. That condition it should fulfill. The second condition is that it should be held for use in the company. You must not buy anything for selling it off. Okay, you must buy it so that you are going to use it in your company and get some benefit out of it. So now what are the three uses you can use your PP in? What are the three uses? The first is either in the production or supply of goods or services. You must use the PP to either produce some goods or supply some services. For production of goods, the example might be that if you go into any manufacturing plant, there you will see that there are a lot of plant and machinery by which the product goes through and becomes a finished product, correct? So those plant and machinery will be a PPE here. Okay, and the supply of services example would be if you go to a salon, there you would go and sit on a chair where you would get your hair cutting services, etc. Right? So that chair is a PPE for the salon because it is helping them in the supply of services. Okay, the second use might be rental to others. So what is rental to others is where you can take the example of the Zoom car company, where what does this company do? This company to its customer gives the car on rent for a few hours. They can use the car and pay them the rent for that many hours that they have used, right? So for Zoom car company, what is the PPE? Their PPE is their car. Their PPE are the cars which they give on rent. So even if you're giving your PPE on rental to others, that can be known as your that will come under the definition of PPE, right? Yes. And the final one is admin purpose. That means if there is a company, okay, you might be in any kind of business, but to do your accounting, suppose you would need your computers, laptops and devices like that. So all of these are used for the administration purpose, right? So these devices would also be known as your PPE only. Okay, so it must be tangible, it must be held for use for any of the three purposes, and the final condition that it has to fulfill is that it must be expected to use more than 12 months. Okay, so if there is any PPE that you have got, it is tangible, you're going to use in the production of goods, but if you're not using it for more than 12 months, then in such case it cannot come under PPE. So all the three conditions it should fulfill to be classified a PPE. Okay. Yes, so before we go on to the entire standard, let's first see where and when does this standard not apply. Okay, so there are 4 cases where this standard does not apply. If there is any PP which is held for sale, I just told you that when will it come under IND AS 16? PP when it is held for use only. But what about PP which is held for sale? Then it will not come under the standard. It will be covered in IND AS 105. Okay, and then you have next is biological asset which is used in agricultural activity. Okay, so what is biological assets? Biological assets means the plants and animals. Plants and animals are what are biological assets. Okay, so if such plants and animals are used in any agricultural activity, then in such case they will not come here. They will go under IND AS 41. You might use a animal, okay, for the production of your goods. Suppose in farming activities, you would have seen that animals are used for production of goods, right? So in such case, can you bring that cow or buffalo or whatever you are using into definition of PPE here as Ind AS 16? The answer is no. All those will go under your Ind AS 41. Okay, but there is one exception here. So what is that exception? The exception is bearer plant. So now what are bearer plants? Bearer plants are any plants or any trees, you can say, which bears the produce. Suppose your mango tree bears mango. So here the mango tree will be known as the bearer plant and the mango will be the produce. Okay. So now talking of the definition, that bearer plant must help in the production or supply of agricultural produce. Okay, anything which produces agricultural produce will be known as a bearer plant. Example, your mango tree, and it must be there for more than 12 months. Okay. And one final condition that the bearer plant has to fulfill here is that it must not be sold as an agricultural produce, or it can either be sold as a scrap sale. So now talking of the example that we took previously itself, we were talking about a mango tree. Okay, we were speaking of a mango tree where we said that the mango tree is a bearer plant and the mango that we get from it is the agricultural produce. Here what they are saying is you should not grow the tree itself to sell as a agricultural produce. Now you would have seen that there are a lot of trees which are grown itself so that they can be later used for a purpose. Okay, but here the purpose should not be the tree itself but the produce that it gives you. If the tree itself is the produce what you are looking for, then in such case it cannot be called as a bearer plant. Okay, because it is not a bearer. Okay, it itself is a produce, right? Or there is one condition that they have told you is that in the end of its life, this tree can be sold as a scrap. That way it can be sold but not as an agricultural produce. So these are the three ways by which you can classify a bearer plant. One is that it must help in the production or supply of agricultural produce. It should be more than 12 months and it should not be sold as agricultural produce itself. So now what about the accounting of this bearer plant? Because bearer plants comes under the definition of Ind AS 16, correct? So it should be same as self-constructed asset. Now what is this? We are going to read in the later part of the standard. Okay. So I hope you would have understood about what does not apply or what does not come into Ind AS 16. Now let's start. So here first we are going to start by seeing the recognition criteria. When will you record this PPE as an asset in your books? In this, even after fulfilling these three conditions which we read above, there are two more conditions which the asset has to fulfill so that it can be recorded in our book. So here what will happen? When you fulfill the first three conditions, it will be known as a PP. But will it be known as a PP for your own company? Will you record it in your books? It will only be decided after you fulfill these two conditions here. Okay. Yes, so now what are these two conditions? So the first condition is that you must get a future economic benefit out of it. That means when you are using this PP, there must be some benefit, okay, which you are getting in the future from it. Suppose if you have a plant and machinery in your manufacturing plant, by manufacturing a few products in the future, you will get money from it. So that is one future economic benefit. So in some or the other way, some benefit you must get out of it. And the next is, the cost must be measured reliably. You must know what cost the plant and machinery is. If you know both of these, then such PP which has already been classified, the asset which has already been classified as a PP can be now accounted in your books. Okay, so now that we have understood the recognition criteria and we have understood that the PPEs should come into the books, okay, at what value are you going to record this in your books is a question here, right? So now here in this Ind AS itself, they have told you that you must record the PPE at the initial cost at which you have got it in your books. Now what is this initial cost? How are you going to find it out is what we are going to understand now. Okay. So first talking about a acquired asset. If it is an acquired asset, that means you have not self-made it or constructed that in your own company itself. You have purchased it from someone else. Okay. So in such case, at what value will that PPE be shown in your books is what we are going to understand. The first component of it would be a purchase price. You have to take the purchase price. At what value you have got the PPE? Suppose you have got the PPE at 10 lakh rupees, then include the 10 lakh as your cost. Once you have taken the purchase price into consideration, the next thing that you have to add here is your non-refundable taxes and duties. Any taxes or duties by where which you are not going to get any credit in the future, that you will have to add it here because it is your cost, and for that you are not going to receive any kind of benefit in the future, right? And then you have to less from it, and then you have to lessen from it what? Trade discounts and rebates. Okay, so trade discount is a discount which you get when you are purchasing in a bulk quantity. So if there is any trade discount of that sort, suppose they are giving you a 5% discount or a 10% discount, then reduce it from the purchase price. So here I've written it wrongly here. So it's less trade discounts and rebates, but add your non-refundable taxes and duties. Okay. And the final one is directly attributable cost. See, any cost that you would have incurred in bringing this acquired asset to the present location and condition, then in such case you have to add that cost also. Suppose any transport charges, any handling charges, any of that sort, then you can add that here. Okay. Yes. So acquired asset, what are the things that you have to include so that you are able to arrive at the initial cost? First is purchase price, and then you have to add your non-refundable taxes and duties, less your trade discounts and rebate, and then add your directly attributable cost. There is one final cost that you have to add so that you are able to arrive at the final value. So what is that? It is known as the present value of site restoration. It is known as the present value of site restoration. Okay. So here what is present value of site restoration means? Suppose let's take an example where you have got a land where you are going to set up your plant where you are going to set up the plant and machinery that you have got of this 10 lakh rupees, and where that is where you are going to do your production. Okay. Now when they gave this land to you, this land was just a empty bare land, but you cannot set up this plant and machinery at empty bare land and start your production. So what you did was you had made a setup in such a way where this plant and machinery can be used and you will be able to get the desired outcome from that. Okay, so now what this owner of this land tells you is that this land I have given you on a lease or rent only for a few years. Okay, when you are giving this land back to me, you have to remove the entire setup that you have made and give the land back to me as in how I gave it to you. Okay, so now what happens at the end of the life? Okay, when you have to return this land, you have to restore the entire site. You have to restore the entire site. You have to dismantle whatever you have done there. Okay, so that cost will also be incurred. Okay, as much as you would have incurred cost in setting up this place, to dismantle this place or restore the site also, you are going to incur some expenses. Okay, so that cost should also be added to the acquired cost. Now, how are you going to find out this cost? Is that you would know what cost would be incurred after a few years. Okay, but today you cannot include the same cost that you are going to incur after a few years because of the concept of time value of money. The amount of money that you are going to spend after the few years is not equal to the amount of money that you will have to spend today. Okay, so that what you have to do is, if suppose 5 lakh is what you are going to spend in the future, bring it to the present value and add that present value. Suppose the present value of it is 3 lakh rupees, then add this 3 lakh rupees to the cost. Okay, so that will be your present value of site restoration. So that cost also you have to add here. Okay, so there is one more point that you have to remember is that if such expenses of site restoration is incurred due to inventory production. Okay, that means you have incurred this site not to build up, not to use it for your plant and machinery, or not to set up your plant and machinery, but to set up area where you're going to use inventory, okay, or produce inventory, which is going to be totally related. These expenses which you have incurred is totally related to the inventory production part. Then in such case you have to bring this cost into Ind AS 2. Okay, but whereas if this cost is incurred to set up a site in such a place where you can use this plant and machinery or any purpose other than inventory, then in such case it can come under Ind AS 16. So I hope you understood this. So we have spoken about acquired assets here. Okay. So then now talking about self-constructed asset, that means this asset you have self-made in your own company or own entity itself. So here how are you going to find out the cost? The cost is going to be the same as your purchase asset only. All the things that you have included in your purchase asset, you will include here also. Suppose you would have purchased the raw materials, include that price. For purchasing the raw materials, you would have spent some taxes, include that. You might have got trade discount, reduce that. There might be some cost that you have incurred to bring that raw material to your place, include that. Then so that site restoration cost, if there is any, you can bring that in also. Okay, so all the costs which you have taken as a part of your acquired asset, the same cost you can bring here. Okay, yes. But there is one thing that you have to remember here is that abnormal loss will be excluded here. What will be excluded? Abnormal loss will be excluded here. So in case when you were making this asset, self-constructed asset, at that time if there was any wastage of material, or if there was any wastage of labor or anything else, then such cost shall be excluded. Here. Okay, yes, so now you have understood what are the part of acquired asset and what form parts of the self-constructed asset. So now what does not form a part of PPE cost is what we are going to understand here. These all costs should not be included in the cost of the PPE. The first is, if you are conducting a business in a new location, and for that if you have incurred some expenses, then that should not be included. If there is any new service or new product introduction that you are doing, for that also, to introduce a product you might incur some expenses, that you do not include here, because this is like a promotion expense, correct? Then opening a new facility. If you are opening a new facility somewhere, it is not directly related to your production. It is about you and your customers and your place and how and where you are going to set up your business. So that cost will also be not included here. And any administration and selling overheads, because that comes after the production process only. So that is also not included. And finally, if there is any incidental operations that you are doing, okay, that will also be not included in the cost of PPE. Okay. So this was all about your initial cost. So now once you have understood about initial cost, let's understand about subsequent cost. Okay, so before I move on to the topic, I'll just wait for a minute. So if there is any questions, you can ask in the chat box, or take a moment to understand the entire chart we have read until now. Okay, yes. So now starting with the next topic, subsequent cost. So talking about subsequent cost, what does subsequent cost mean? Subsequent cost means the cost which you incur year after year once the PPE is ready to use and is being in use. Okay. So here there might be different kinds of subsequent costs that you might incur. First, let's talk about the repairs and maintenance. Suppose even if you have got a bike for yourself, you need to repair and maintain it every 6 months so it runs smoothly. Okay, so such repairs and maintenance are just a day-to-day cost. Okay, so that day-to-day cost will be expensed to P&L. Okay, suppose in the factory there might be one plant and machinery, and this plant and machinery, suppose a bolt would have fallen down, due to which the machinery might not work. To fix that bolt or to fix something else, you would have called some some person who would repair it. Okay, so in that case what will happen, it's just a small day-to-day cost that you can expense it to P&L. Okay, now talking about the next cost, which is the replacement of parts of PPE. So what happens is that in a bike, what happens, after a point of time you might change the entire engine of the bike itself. Here you are not doing just normal repair and maintenance, but you are changing or replacing a major part of the PPE. So when you are replacing something so major, suppose the bike is for 50,000 rupees, okay, and the engine itself will cost you 15,000 rupees to replace. So in such case, what will happen? This is a very big expense that you are making. So you have to capitalize this expense if it is going to increase the efficiency of PPE in the future. That means what the PPE is performing now, if the PPE is able to perform better in the future and in a better efficient way, then in such case you can capitalize this cost. Okay, yes. So here when you're capitalizing this cost, you have to remember one thing, that in this bike also, when you're going to put in a new engine, there will be one old engine there. So for that old engine, you would have incurred expense. Suppose you incurred 10,000 rupees for that old engine. Suppose we would have not incurred it separately, but we just know that the old engine value was suppose 10,000, then in such case you have to first de-recognize this. That means you must first reduce this from the value of bike and then add the new engine value to it. Okay, so de-recognize any old part value from there. Okay, next we are going to see about major inspection or overhaul. So here what happens is that in airline industries, example, there in every 3 to 5 years they do a full inspection of the airline. They do a full inspection of the airline and check each and every minute part in the airplane. Okay, so what happens when they do this is that in case if some mishappening could have happened in the future, because of this major inspection, that mishappening can be stopped. Okay, so this major inspection is also will also be for a big value. Okay, when you do this major inspection, you will incur a lot of cost and it will be of big value. You can capitalize this cost if the recognition criteria is missed. If whatever recognition criteria we read, for recognizing a cost, that is, you must get future economic benefits, the cost must be measured reliably. If those criteria are met, you can capitalize this major inspection cost. Okay, and when you are capitalizing this cost, remember to de-recognize the old inspection value. Remember to de-recognize the old inspection value. Okay, so I hope you understood about subsequent cost also. So here we have completed this chart and there is one final topic left here. Okay, so cost measurement. So here they talk about cost measurement. So there are two special cases they have given you, and in that cases how are you going to measure the cost is what we are going to learn here. The first case is when the payment is beyond normal credit terms. Okay, or we can call this as a deferred settlement case also. So what happens is that usually when you are purchasing a PPE, the normal credit term by which you can make the payment of such PPE is suppose 1 month. Okay, so here you are expected to pay within 1 month, and if you are paying it within 1 month, there will be no extra charges, etc. Now here what happens is that this is a normal credit term, but you are not paying within 1 month. Rather than that, you are paying after 6 months. Rather you are paying it after 6 months. So what happens is that here when you are paying after 6 months, suppose if you had to pay within 1 month, you were paying 10 lakh rupees. If you have to pay after 6 months, you are going to pay 15 lakh rupees for that PP. Here, because the time has exceeded beyond the normal credit terms, you have to pay something extra. This hidden cost what you are paying here is known as your interest. This what you are paying is hidden here. 5 lakh rupees, the difference between this both. The 5 lakh rupees is your interest here, and this you are paying because there is a time value of money. Okay, so as and when the time goes on, the value of the money goes less. The 10 lakh rupees that you will pay after 1 month will not be equal to the 10 lakh after you are going to pay after 6 months. So you have to pay extra. Right, yes. So interest, how do you find out the interest part? You are going to see what is the total payment you have made, that is 15 lakh rupees minus the cash price equivalent. Cash price equivalent means if you would have paid it within the normal credit term itself, how much you would have paid. Okay, so that cash price equivalent is what considered here, which is your 10 lakh rupees. So 15 lakh minus 10 lakh, 5 lakh is your interest. Okay, so how are you going to recognize this interest? Okay, so you have to expense this interest over the credit period. You have to expense it off to your expense it off to your P&L, like amortize it over the period. Okay, at one stretch itself you need not record it. As when the period goes, you can recognize it. Okay, but there is one condition where you have to capitalize this interest. Okay, so when are you going to capitalize this interest? Is if Ind AS 23 borrowing cost is going to get applied and it is going to tell you that you have to capitalize such interest, then in such case capitalize it, or else amortize it and expense it off to the P&L over the credit period. Okay, so I hope you understood this. Now talking about the second part of this cost measurement, here we talk about the PPE which is acquired in exchange of another PPE. So here you do not put in your money to get a PPE, but here you give one asset and get back an asset. Here there is an exchange of assets. Okay, so here how are you going to find out the cost of such PPE which you have acquired in exchange? Suppose we have given out a house or a building. We have given out a building, and in return you are getting some plant and machinery. Okay, so at what value are you going to record the plant and machinery that you have got in your books is the question here. So first priority what you have to give is you have to find out the fair value of asset given up. That means what is the fair value of this building you have to find out, and you have to add if there is any cash paid. So when you are getting this plant and machinery, one, you gave the other person the building and you also gave them a cash of suppose 1 lakh rupees. Okay, so in such case what are you going to do? What will be the value at which this plant and machinery will be recorded in your books? One, you have to record it in the fair value of asset given up, and in case if they have paid any cash also add it. So that will be your first priority at which you will record the PPE in your book. Okay. So now talking of the second priority, in case if you're not able to find out what is the fair value of the asset given up, then record that PPE in your books or record the plant and machinery in your books at the fair value of asset received. So you have received this plant and machinery at what fair value, when you have received it, what was the fair value, and that fair value you can record it. Now fair value of asset is all given up is also not there. Fair value of asset received is also not there. So in such case, what are you going to do? You have to take into consideration the carrying amount of asset given up. You have to take into consideration the carrying amount of asset given up. That means at what value was this building shown in your books? At what value was this building shown in your books? Take that book value itself, okay, and record that plant and machinery which is coming in at that book value of building itself. Okay, so these are the three ways by which you can record a PPE which you have acquired in exchange, and this is the priority also. First, fair value of asset given up plus any cash paid. Second is fair value of asset received, and third one is carrying value of asset given up. Here one more, so here there might be two cases. One when there is some commercial substance, and then there might be some second case where there is no commercial substance. Okay. So what does commercial substance mean here is that commercial substance means when you're going to acquire this asset in exchange, you are expecting that the asset that you're going to acquire is going to give you some cash flow in the future. You are expecting some cash flow out of it in future. Okay. So that is when you, that is when it is said that a transaction has a commercial substance, when you're, expecting some benefit or cash flow out of it in the future. Now there might be a case when there is no commercial substance. Okay, that means you would have given your car. Suppose you would have given your car to one company, and they would have in return given you their bike. Okay. So here what you are doing is that you are not expecting any commercial substance out of this transaction. Rather you just want to test how the bike works, or that company just wants to test how the car works. So you just are exchanging in such a way that there is no commercial substance, and you just want to test out the products. Okay, there's nothing benefit or any future cash flow you're expecting from such exchange. So such exchange will be known as a transaction where it lacks commercial substance. So in such case, here in this case, the bike that you have received from the other company, at what value you are going to record it at the value at which this car was being shown in our books. The book value of this car is the same value at which this bike will be recorded if it comes to our firm. Okay. So that was the case. So this case is where you lack commercial substance, and there you have to take carrying amount of asset given up. Okay. So this is how you are going to measure your cost. So now we have come towards the end of the first start. So let's quickly go through this. First, we started with the definition of PP, where we read that it must be tangible, it should be held for use, and it should be expected to be used for more than 12 months. Then you read the recognition criteria, where you understood that it must give future economic benefit and cost must also be measured reliably. Then we understood at what cost you're going to put it in your books, whether it is acquired asset or a self-constructed asset. According to that you will do it, and what are not included as a part of your PPE also you understood. Then we read about subsequent cost, where we read about how we account for repairs and maintenance, how we account when there is a replacement of part, and what you do when there is a major inspection. Then finally we understood the cost measurement, two special cases. One where you pay beyond normal credit terms, and the second is where you have acquired a PP in exchange of another PP. Okay, so I hope there is no doubts until this. I'll just give you a minute to go through all of this and understand. Okay, yes. So I hope you would have taken your minute. If you need more time to just sum it all up, you can pause the video and see it, and then you can resume back to the video. Yes. Okay. Now moving on to the second chart, where it talks about the cessation of capitalization. Here what they tell you is that until now we have read what and all is going to be capitalized as a cost of your PP, like your initial cost, and then in your subsequent cost also what and all can be capitalized we have read. So now when does such capitalization stop? When do you stop capitalizing in your PPE? Is when your PPE is ready for use intended by the management. Okay. So a management would have thought that if the PPE is able to start the production, okay, if you are able to put that PPE into productive use and it can give us back some produce, then in such case the management would have said that this PPE is ready to use. Okay, so when whatever is intended by the management, in that way, if that PPE is ready for use, then at that same very particular moment you will stop capitalizing any cost that you incur on that PPE after the point, after it is ready to use by the as intended by the management. All the cost would go into your P&L only. You will not capitalize anything. Okay, yes. So here talking of a few examples, but before we move on to the next, I just want to clear out this. I'm talking about initial cost only here. Okay, subsequent cost I'm not talking about here. I'm talking about the initial cost only here. Subsequent cost, in case if there is any major expenses or any replacement, then in such case that can be capitalized, but otherwise other expenses you cannot capitalize. Okay, so let's see a few examples which are given here. So the first example here tells you that what if the PPE is ready to use but it is operating less than full capacity. That means here what they are telling you is that there is a plant and machinery, okay, it's ready for use, it can produce and give you 100 units or 1000 units, but you are not yet utilizing it to its full capacity. So in such case what will happen? They are asking, since it is not being operated in the full capacity, can we just assume that it is not 100% ready and we can still keep on capitalizing the cost? Here the answer is no. If once the PPE is ready to use, you must stop your capitalization. Okay, whether it is operating in full capacity or less than full capacity, that is not a matter of concern. Okay, so once the PPE is ready for use, you must stop capitalizing the cost. Okay, the next is the initial operating losses. The PPE is ready to use, but once you have started using the PPE, you are incurring some losses out of it. There is no benefit that you are incurring. Okay, we read a condition that PPE must give you what? Future economic benefit, but here they are telling you that there are initial losses, but in the future you're going to get profits anyway. Okay, because when the start of any business would incur a loss. So here what we tell is that PPE it is ready to use. Initially if you are incurring some losses, that should not be a matter of concern, because anyway in the future you are going to get benefits out of it. So stop the capitalization then and there when your PPE is ready to use. And the final one is reallocating or reorganizing operations. So here what they tell you is that the PPE is ready to use. Okay, but what happened is that first we were planned that we would have our plant at area 1. But in this area 1 now, due to some problems, you are shifting your PPE to area 2. Okay, the PPE was ready to use when the area 1 was there itself. But now since you have to shift to area 2, the PPE might not be able to use, you might not be able to use the PPE for some more period of time. So for that some more period of time, whatever cost you are incurring, can you capitalize it? The answer is no. For your relocating and reorganizing operations, if there is some time taken and in that space, even if the PPE has been ready to use, you have to stop capitalizing. You cannot wait till you relocate and reorganize your operations. Okay, if it is ready for use, cease the capitalization. Okay, I hope you understood this. Let's talk about subsequent measurement now. As you all know that every year, annually, you have to value your PPE and record it at the best possible way. Okay, so there might be two models which you can follow in your subsequent measurement. The first one is your cost model. Okay, so what does it tell here is that when you are going to record your PPE, first time you would have recorded it initial cost, no doubts in that. Okay, second time when you are recording it in the second year, at what value should it be shown in your books? At the second year end, at what value should it be shown in your books is what you are going to understand. And in the cost model, what they tell you here is that the carrying value at the second year end would be the cost, that is the initial cost at which you recorded, minus accumulated depreciation. Okay, for that year there would have been depreciation for the PPE, reduce that, minus any accumulated impairment. If you think there is any impairment that you have to reduce from the asset, do that also. So cost minus accumulated depreciation minus accumulated impairment. So if you do these three, you will get the carrying amount of at what you have to record your asset in the subsequent years. Okay, so this you have to, if you are following a cost model, you have to use the same formula each and every year and arrive at your carrying value for the year end. Okay. Now there is one more model which is known as a revaluation model. Okay, So talking of revaluation model, here how do you find out the carrying amount of the PPE every year end? Is that you have to take the fair value at the date of recognition. That means at the second year end, you have to take at that on 31st March 2022 at this date. Suppose you initially recognize this PPE on 31st March 2021. First year end. The second year end, how are you going to recognize it? See the fair value at the date of recognition. That means 31st March 2022. What is the fair value of the asset? Take that minus the same thing, subsequent accumulated depreciation and minus accumulated impairment if there is any. Okay, so if you do this, you will be able to arrive at the carrying value of the PP. Okay. So when you are doing revaluation model, there are two methods which you can follow. Under revaluation model itself, there are two methods which you can follow. Okay, so here what they are telling you is that there are two methods. The first method is depreciation elimination approach. Depreciation elimination approach. So here what we are going to learn in these two methods is that how are you going to arrive at this carrying amount, or how are you going to account it in your books. Okay, so first talking of the first method, that is your depreciation elimination approach. When you are going to account the PP in your books, okay, in the subsequent years, first what they are telling is that eliminate all the accumulated depreciation that you have related to PP. Suppose if there is some 5 lakh rupees of accumulated depreciation, what you can do is you can do depreciation, accumulated depreciation account debit to asset account credit, to asset account credit. So when you are going to credit the asset, what is going to happen? You are going to eliminate the depreciation. Okay, so they are telling first remove the depreciation. The second thing that you have to do is account for the revaluation gain or loss. So when you are revaluing it, what happened when you are revaluing it, the fair value might either be more than the initial cost that you recorded it in, or it might be lesser than the initial cost that you recorded it in. So there might be a revaluation gain or there might be any revaluation loss. Okay, so you have to account for such revaluation gain or loss. When are you going to incur this, or how are you going to find out this revaluation gain or loss? Whenever there is a difference between your initial cost and your fair value at the subsequent measurement date. Okay, so you have to account for this revaluation gain or loss. So if there is a gain, what you can do is you can increase your asset with that, and if there is a loss, you can decrease your asset accordingly. Okay, so this is how you are going to do using the depreciation elimination approach. First, eliminate the depreciation from the asset, and second, account for the revaluation gain or loss. Okay. Yes. So here, next we are going to talk about the second approach. Here, how are you going to account for the revaluation gain or loss? You are going to use a restatement approach here. You are going to use restatement approach here. So here, first, what you are going to do is, if suppose let's take an example that there is a revaluation gain, okay, so you have to first calculate the surplus percentage. That means by how much percentage is there an increase in value of the PPE, how much is the revaluation gain, as a percentage you have to find out. How will you find out? You first take the fair value of the asset. Suppose the fair value is 15 lakh rupees today, you have to minus the carrying value. Carrying value was suppose 10 lakh in the books. So 15 lakh minus 10 lakh divided by 10 lakh into 100 if you do. That is fair value minus carrying amount divided by carrying amount into 100. If you do so, you will be able to arrive at your surplus percentage. Let's do on the calculator. So it's 15 lakh minus 10 lakh divided by 10 lakh into 100. So it is 50%. Okay. So 50% is your surplus percentage. Okay, so by 50%, your carrying value, the value of your asset has gone up. So first find out the surplus percentage. Now what you have to do is, here you have to increase both your original cost. Here you have to increase both your original cost and your accumulated depreciation by such surplus percentage. Suppose your asset was being shown at 10 lakh rupees in your books, right? So you have to do plus 50% so that now it comes up to 15 lakh rupees. You have increased the original cost of the asset. Now you have to see about the accumulated depreciation. Suppose accumulated depreciation in the books was 5 lakh rupees. You have to do 5 lakh plus 50% and you have to show it at suppose 7.5 lakh in your books. So what is going to be the entry of this here is that you have to increase your asset, right? So asset account, you are going to debit it with whatever the increase is. Whatever the 50% is alone, you will increase it here. So 50% here was 10 lakh. 50% of 10 lakh. So 50% of the initial value, which is your 5 lakh rupees. And then you have to increase your accumulated depreciation also. So to accumulated depreciation, What is the 50% increase here? 5 lakh plus 50%. So what was it 50%? 5 lakh into 50%, which is your 2,50,000. You increase with that, and then to revaluation reserve, how much ever the total gain was, revaluation gain was, you have to write it here. I hope you understood this. Let me just take you through again. If you are using the depreciation elimination approach, first eliminate the depreciation. Do depreciation account debit, accumulated depreciation account debit to asset account and eliminate the depreciation. Then account for the revaluation gain or loss. That means you will make a entry here. You will increase the asset cost. So asset account debit to your revaluation gain or revaluation surplus or revaluation reserve account. Okay. Yes, you have to do that. So that is how you will account your revaluation gain or loss. If you reverse this entry, you can account your revaluation loss. Then in the second method where we spoke of restatement approach, first you have to calculate your surplus percentage, that from the initial value what you had recorded in the books, from till how much percentage has there been an increase in the fair value. So first find out that surplus percentage, and then if there is a surplus, okay, if there is a gain I'm talking about here, then increase your original cost also and accumulated depreciation also by that percentage itself. Okay. Yes. So I hope you understood this, and vice versa for if there is any revaluation loss. Is there any doubts until this? Any doubts until this? So I hope there is no doubts. Okay. So now let's move on to the next topic where we talk about the other topics which is related to revaluation model. What you have to remember is that revaluation should be done on class by class basis. That means if you have assets, okay, in your books you have buildings, then you have suppose what others can be, plant and machinery, and you have some furnitures and fixtures. Okay, so all these are your PPEs only. Okay, they are different types of PPE that you have in your books. So when you are applying this revaluation model, or when you are seeing this cost model, revaluation model, you have to apply this revaluation model on one is that you have to apply this on asset by asset basis. That means for buildings separately you have to apply revaluation, for plant and machinery separately you have to apply revaluation, and for furniture and fixtures you have to separately apply revaluation. That means for building you have to separately check what is the fair value. For plant and machinery you must separately check what is fair value. For furniture and fixtures you must separately check what is the fair value. But here one thing that you have to remember is it is not only asset by asset basis. You can apply revaluation model class by class basis also. If suppose there are two kinds of buildings, one that you are using for your industrial purpose or for production purpose, and the second building is like a office building to you. Now when you are applying this revaluation model, you can apply separately on industrial buildings and separately on office buildings also. So separately on industrial building you can see what is the fair value, separately on office buildings you can see what is the fair value. So you can always apply this revaluation model on class by class basis. Okay, on different, in the same asset itself there can be different classes, on that you can apply. Next is what will be the frequency of your revaluation. How frequently should you reevaluate your asset? Okay, suppose if the asset has some significant changes and volatile changes every single year, the value or the fair value of the asset keeps on fluctuating. So if in that case, what happens if every single year your value is significantly changing, then you have to revalue the assets annually. Okay. But what if it is otherwise, that there's no significant changes as such, every there is no much volatility in the rate or in the value or in the fair value, right? So in such case you can evaluate every 3 to 5 years. Okay, then only and only if there is any significant and very volatile changes every year in the fair value, then please revalue it annually, or else you can do it 3 to 5 years. Okay, yes, done. So that was all about your what other topic we had to discuss. Now we have to discuss about the subsequent revaluation. Okay, subsequent revaluation means first you record it at the initial cost. Second year you did the revaluation. Now third year when you are going to subsequently reevaluate, how are you going to account it? How are you going to account it is what we are going to understand. So what happened first time when you did your revaluation, what you would have done? If there was any gain, you would have put the gain in your other comprehensive income, in your OCI. Okay. If there was any loss, you would have put it in the P&L account. You would have put it in the P&L account. So if there was a revaluation gain when you did it for the first time, it would go into OCI. And if there was a revaluation loss, it would go into P&L. That was in the first time. Now what about after the first time? What are the subsequent years? Okay. So if in the previous, that is in your first year, if there was any gain, or in the previous year if there was a gain, and now again you have got a gain, and this year also again if you have got a gain, then it will go into OCI only. Okay. So now if previous year there was a loss, this time also there is a loss, then it will go into P&L only. Okay. So as usual it will go into those accounts where it has to go. But now, so here problem arises when previous year you have a gain, but in the current year you have a loss. So previous year you would have put it into OCI account, but current year what you will have to do? You will have to put it in the P&L account because of a loss. So first, before completely transferring the loss to the P&L account, what you do is whatever balance you have that in the OCI, you first reverse it. You first reverse that amount, and even after that if there is some extra loss that you still have to account for, then in such case you can account your P&L account. So first use the OCI and reverse it, and then use the P&L account. And the next case is where previous year you have a loss and in the current year you have a gain. So here what happens is that in the previous year you would have accounted it in your P&L account. In the previous year you would have accounted it in your P&L account. And in the current year, because you've got gain, you have to record it in the OCI account. So here what happens is same case. First, whatever gain you have got, first reverse the P&L account, whatever balance you have it in the P&L account within which you have accounted the loss. First reverse that loss, and even after that there is some gain left that you have to record for, then you can use the OCI account. So first use the PL account and then you can go on to your OCI account. Okay. So I hope until this everything is clear. Okay. So revaluation model, completely we have understood all the aspects. We understood how will we come to the carrying amount, what are the methods you are going to use, what are the other topics, and what is the subsequent revaluation that you are going to do. Okay. Yes. So now that we have completed that topic, let's move on to the next topic, which talks about depreciation. Okay. So in relation to depreciation, here we are going to understand first what are the ways of depreciating. Okay. So here how do you depreciate an PP? How do you depreciate an asset? Is in the pattern of the future economic benefit that you are going to receive it, you have to depreciate that asset in such a way that by the end of useful life it happens so that all the future benefit that you have to receive, you have received it all and there is nothing more to receive. Okay, so that's how you have to depreciate your PP. So what are the methods by which you can depreciate? There is SLM method, that is your straight line method, WDV method, return down value method, or your units of production method. In SLM method, what happens? Every single year you use the same amount and only depreciate. Okay, every year 10,000, 10,000, 10,000, 10,000. In WDV method, what happens? You apply a similar percentage every year on the carrying value or on the book value of the asset, whatever is left at the year end, and in that you depreciate. And what about the units of production method? Here, depending on the units that you are going to produce, suppose you have the useful life of the asset is 3 years. In the first year, you are going to produce 1000 units, in the second year 2000 units, and in the third year 3000 units. So in this ratio, you will depreciate your asset in the ratio of 1:2:3. Okay. So first is a depreciation total value, you will split it in this ratio. Okay. So I hope you would have understood all these three methods. Now, you have to also understand that you can use different depreciation percentage and different depreciation methods for the main asset and for the other significant parts. That means for different assets, you can use different depreciation methods and percentage. That is no problem. I am here talking about a single asset. Here in a single asset itself, if there is any significant part which is significant and material in value also, you can split this asset as two. One as significant part and the other one as others. Okay. And for this significant part of the asset, you can use a different depreciation percentage and a different depreciation method. Whereas for the other parts of that single asset itself, you can use a different depreciation method and a different depreciation percentage. So in that main asset itself, if there is any significant part, you can use a different one for it and different for the other insignificant parts. Okay. So I hope you understood this also. Okay, now talking about the residual value, you have to review whatever the residual value is, review it annually. That by the end of the useful life of the asset, how much residual value will it hold? Okay, so this if there is any change in residual value, it will be known as a change in accounting estimate. It will be known as your change in accounting estimate and it will come under your IND AS 8. Okay, yes. So here one thing that you have to understand in relation to depreciation and residual value is that if the residual value is greater than or equal to the carrying amount. That means your carrying amount is 10,000 rupees. If your carrying amount is 10,000 rupees in your books, okay, but the residual value is 50,000. That means right now your asset value in the books is 10,000 only. But you are telling that by the end of the 3 years or 5 years that you are going to use the asset, you are going to get 50,000 as a residual value. Okay, that means right now itself the carrying value is either less than the residual value or equal to the residual value. Okay. So here, you need not further depreciate the asset. You need not further depreciate the asset. Why do we depreciate the asset? We depreciate it to such a value that it comes closer to the residual value. Now that the carrying value itself is lesser than the residual value, then you need not depreciate. So here the depreciation will be equal to 0 until the residual value again comes below carrying amount. Okay, suppose what happens in the next year revaluation, your residual value becomes 5,000. Whereas your carrying value still stands at 10,000. So in such case, now you can start depreciating again. But until and unless the residual value is not less than the carrying value, you need not depreciate it. Okay? Yes. So I hope you understood that also. Now talking about the commencement of depreciation. So when do you commence depreciating an asset? Whenever it has become ready to use, from that time itself you can apply the depreciation and start to depreciate it. Okay. So when will you stop depreciating? Earlier of held for sale. Either what you do is that PPE, you have made it held for sale. You are using it, but currently you do not need it, so you categorize it for selling it. Okay, at that time you can stop depreciating the asset, or else if it has been completely derecognized, if you have derecognized the asset itself, then in such case you can stop the depreciation of the asset. So whichever earlier of held for sale or derecognizing it, whatever event happened first, depending on that you can stop your depreciation. Okay, yes, I hope you understood this. And then there is a final topic on impairment and derecognition. Now here talking of impairment, we are going to cover it under another standard. Okay, so we are not going to discuss it here, but related to derecognition, let's discuss it here. Okay, so related to derecognition, so here what they are telling you is that when shall a PPE be derecognized? When shall a PPE be derecognized is that either on disposal of that asset, it can be derecognized, or when you think that there will be no future economic benefit from the asset, at that time you can derecognize. Either when you are disposing of the asset, or when you think that there is no future economic benefit that you are going to receive from the asset, you can derecognize it then. Okay, so when you are derecognizing it, okay, so if there is any gain or loss that you are getting from such derecognition, then such gain or loss will come under your P&L as an other income. And the next point that you have to remember is how are you going to find out this gain or loss? Whatever net proceeds that you are going to receive by selling of that asset minus whatever your carrying value was. If you do a difference between the both, you will either get your gain or loss. Correct. So yes guys, so this was all about IND AS 16. So just summarizing this second chart once again and going through all the topics what we have read. First we understood when we cease the capitalization on a PPE, when it is ready for use as intended by the management. Okay, then we read about subsequent measurement, that what are the two models you apply to subsequently measure it. One is cost model and then there is revaluation model. In revaluation model also, if you subsequently reevaluate, how are you going to reevaluate it? You have understood that. Then we understood about what is depreciation, what are the different types or methods by which you can depreciate, when will you commence a depreciation, when will you cease a depreciation, and then we finally spoke of derecognition. Okay, so yes guys, so this was your entire IND AS 16. I have covered all the concepts which were there in the institute study material. In case if there is any doubt, feel free to post it down in the comment section below. And this mind map, as said in the earlier part of the video, will be available through any of the links that is given in the description box. So kindly check that out and make the best use of this. And yes guys, so thank you so much for joining in today's video and today's session. In case if you found this video helpful, please make sure to like, share and also subscribe to the channel, and don't forget to share it with your friends for whom this might be of help.